Look, inflation is eating your savings alive right now. Every dollar sitting in the bank is worth less today than yesterday. But here's what the wealthy know. There are assets that don't just survive inflation, they thrive on it. I'm about to walk you through 11 inflation-proof assets that actually hold value. Some are ancient, some are cutting edge, and a few are so strange you'll wonder why anyone thought of them. By the end, you'll know exactly which ones match your budget, goals, and risk tolerance. Let's get into it. Number 11. Palladium. This one's a pure beast if you like precious metals but want something that's not just sitting there looking pretty. Palladium is a silvery white metal critical for modern technology, catalytic converters, electronics, dentistry, and hydrogen fuel cells. Palladium has outpaced inflation consistently since 2000, hitting peaks over $3,000 per ounce. It's rarer than gold or platinum, with massive industrial demand that isn't going away. When currencies weaken, industrial metals with limited supply explode in value. Perfect for someone with moderate capital who wants precious metal exposure without following the crowd into gold. Buy physical palladium bars, coins, or ETFs. The downside? Volatile as hell. Prices swing 20% monthly. It's also not as liquid as gold. This is for someone who can handle volatility with a 5 to 10 year timeline. Need quick cash or risk averse? Skip this one. Number 10. Collectible weapons and firearms. You'll love this if you're into history, craftsmanship, or things that hold mechanical value. Collectible firearms aren't about stockpiling AR-15. I'm talking historically significant weapons, limited production runs, or firearms with documented provenance. A World War II Luger appreciates faster than most stock portfolios. Pre-1899 antique rifles aren't even legally firearms in the US, and collectors pay serious money. Colt Python revolvers that sold for $600 in the 1980s now go for $3,000 to $5,000. The inflation hedge, firearms combine scarcity, historical significance, and functional utility. They're tangible assets that can't be printed like currency. During economic uncertainty, demand spikes dramatically. Ideal for someone who knows guns, understands the market, and has secure storage. You need knowledge. Buying random guns won't work. Target condition, rarity, historical importance, and documentation. Start around $1,000 for entry-level collectibles, but serious pieces run $5,000 to $50,000 plus. Not for someone who doesn't understand firearms law, lacks proper storage, or can't assess authenticity. This is a long-term hold, not a quick flip. Number 9. Fine art. This sounds fancy, but there are ways to play at different levels. Fine art has been an inflation hedge for centuries because it's scarce, culturally significant, and wealthy people always want it. A Picasso bought in 1960 for $100,000 would be worth tens of millions today. Mid-tier contemporary artists have outpaced inflation by 3 to 5 times over 20 years. The art market doesn't correlate with stocks, so when everything crashes, art often holds or gains value. The play. Serious money buys established artists through galleries or auctions. Smaller capital targets emerging artists, limited prints, or fractional ownership platforms like Masterworks. Perfect for someone who appreciates art, understands cultural trends, and has money they won't touch for 10 plus years. You need to actually like art. Downsides. Illiquid, requires insurance and storage, authentication is tricky, and the market is subjective. Trends change. Artists fall out of favor. Need liquidity or won't study the market. Skip this. But with capital and patience, art has protected wealth for centuries. Number 8. Bitcoin. This one's controversial, but Bitcoin has outpaced inflation more aggressively than almost any asset this past decade. Someone who bought $1,000 of Bitcoin in 2013 sits on over $100,000 today despite multiple 50% plus crashes. Bitcoin's inflation hedge thesis is simple. There will only ever be 21 million Bitcoin. No government can print more. No central bank can debase it. It's mathematically scarce. When currency printing accelerates, Bitcoin rises because people flee to fixed supply assets. Yes, it's volatile and crashed 80% multiple times. But zoom out, every major crash preceded new all-time highs. Institutional adoption is real now. BlackRock, Fidelity, corporations, even countries hold Bitcoin. Ideal for someone young enough to handle volatility, tech-savvy enough to secure holdings properly, and patient enough to hold through crashes. Start with $100. Dollar cost average. Don't need a whole coin. The downside? Stomach 30 to 50% drawdowns without panicking. Secure Bitcoin properly. Hardware wallet, not exchanges. Ignore noise and hold long-term. Nearing retirement, need stability, or can't watch 40% drops, Bitcoin's not for you. But building wealth over 5 to 10 plus years? Bitcoin's fixed supply makes it one of the purest inflation hedges available. Number 7. Ethereum. This one's a beauty if you understand we're watching the internet rebuild itself. Ethereum isn't just cryptocurrency, it's a global computing platform running decentralized applications, smart contracts, NFTs, and most of the crypto ecosystem. Bitcoin is digital gold. Ethereum is digital infrastructure. Owning infrastructure during economic expansion creates wealth. Ethereum moved to proof of stake in 2022, making it deflationary. Supply actually decreases over time when network usage is high. Ethereum went from $10 in 2017 to over $4,000 at peak. Even after crashes, it held value better than most tech stocks. Ethereum captures value from an entire ecosystem. As more applications run on Ethereum, demand increases while supply becomes scarcer. Perfect for someone comfortable with technology, believing in blockchain's long-term potential, wanting exposure beyond Bitcoin. Start small, $50, $100, whatever. You can stake Ethereum and earn yield. The downside? More volatile than Bitcoin. More technically complex. Regulation is uncertain. Competing platforms exist. You need to understand what Ethereum does, not just buy because someone told you. Don't understand smart contracts, DeFi, or programmable money. You'll panic sell at the worst time. This is for someone who's researched and genuinely believes blockchain infrastructure is the future. Number 6. Agricultural land. Perfect if you have serious capital and want something tangible, productive, and historically proven. Agricultural land has been wealth preservation for thousands of years. They're not making more of it. People always need food, and farmland produces income while appreciating. Farmland matched or beaten inflation over the past century with remarkably low volatility. During the 1970s inflation crisis, farmland appreciated 10 to 15% annually while stocks crashed. From 1992 to 2022, U.S. farmland returned 11% annually. Even in recessions, farmland holds value because food production doesn't stop. The play? Buy land directly and lease to farmers, operate it yourself if you know farming, or invest through farmland, REITs, or platforms like Farm Together or Acre Trader. Ideal for someone with significant capital, $50,000 plus, long-term mindset, 10 to 20 years, wanting low volatility with steady income. Farmland produces crops, revenue, and pays you. It's tangible. Visit your investment. Downsides: illiquid, can't sell quickly, requires management, property taxes, maintenance, and weather risk. Need liquidity or working with under $50,000. Not realistic. But with capital and patience, farmland is one of history's most proven inflation hedges. Number 5. Water rights. This one is strange, but water rights might be the single best inflation hedge for the next 50 years. We're heading into global water scarcity, and people controlling water access will be extraordinarily wealthy. Water rights are legal entitlements to use water from specific sources: rivers, aquifers, wells. In the western US, water rights are bought and sold separately from land. A single acre-foot in California sells for $1,000 to $3,000 depending on location and seniority. In water-scarce regions, rights have appreciated 5 to 10 times over 20 years. Why this is an inflation hedge? Water is non-negotiable. You can live without gold, Bitcoin, or art. You cannot live without water. As climate change intensifies, agriculture expands, and populations grow, water becomes more valuable than oil. Perfect for someone with very significant capital, $100,000 plus, a 20 to 30 year timeline, and comfort with complexity. Buy senior water rights in water-scarce regions, lease to agricultural or municipal users, watch value compound as scarcity increases. Downside? Complicated. Water law varies by state, rights have seniority levels, need legal expertise, completely illiquid. Without serious capital, legal support, and willingness to hold for decades, this isn't accessible. But if you do, water rights might be the single best asymmetric bet on scarcity economics. Number 4. Lego sets. This sounds insane until you see the numbers. Retired Lego sets quietly outperformed gold, stocks, and bonds over 15 plus years. Research from Russia's Higher School of Economics found Lego returned 11% annually from 1987 to 2015. A 2007 Millennium Falcon retailed for $500, now sells for $5,000 plus sealed. Cafe Corner went from $150 to $2,500 plus. Limited Star Wars, Harry Potter, and architecture sets consistently appreciate 10 to 15% annually after retirement. Why it works. Manufactured scarcity. Retired sets are never reproduced. Fixed supply. Exploding global demand from adult collectors driven by nostalgia and cultural permanence. Perfect for $200 to $5,000 budgets wanting something strange and accessible. Buy limited releases, keep sealed, store properly, wait 5 to 10 years. Downside, need knowledge, random sets won't appreciate. Licensed themes perform best. Storage adds up, you'll be tempted to open them. But research smart and resist building, Lego offers one of the strangest proven inflation hedges available. Number 3. Rare whiskey. Love this if you appreciate finer things and want an asset you can enjoy while it appreciates. Rare whiskey has quietly become one of the best performing alternative assets this past decade, outpacing wine, art, and even some stock indices. Macallan 25 years sold for $500 in 2010, now sells for $2,500 plus. Japanese whiskeys went insane. Bottles that were $100 5 years ago are $1,000 plus today. The Rare Whiskey 101 index showed 564% growth from 2010 to 2020. Why whiskey works, it's consumable. Supply decreases as people drink it. Age limited, can't make 25-year whiskey without waiting 25 years. And global demand explodes, especially from Asia. Unlike wine, whiskey doesn't spoil. Sealed bottles last indefinitely. Perfect for someone who enjoys whiskey, has moderate capital, $1,000 to $10,000, and wants something tangible and enjoyable. Buy limited releases, discontinued bottles, single cask releases, or anything with age statements from reputable distilleries. Store properly, sealed, upright, cool, dark. Downside? Need knowledge. Random whiskey won't appreciate. Understand distilleries, age statements, limited releases, storage matters, authentication matters, fakes exist. And there's temptation to drink your investment. Don't know whiskey or can't resist opening bottles? Skip this. But if you're a whiskey person with patience, this is one of the most enjoyable inflation hedges available. Number 2. Vintage watches. This one's a beast if you appreciate craftsmanship, heritage, and mechanical perfection. Vintage watches from Rolex, Patek Philippe, Audemars Piguet, and Omega have destroyed inflation over 30 years. A Rolex Submariner sold for $2,000 in 1990 now sells for $10,000 to $15,000. Certain Patek Philippe models appreciated 10 to 20 times. Rolex Daytona, Paul Newman models went from $200 in the 1970s to millions today. Mid-tier vintage Omega Speedmasters tripled or quadrupled. Why watches? Wearable wealth, mechanically complex, can't be replicated by printing money. Heritage and brand value, fixed supply. They're not making more vintage 1960s Submariners. Demand is global and growing, ideal for someone with moderate to significant capital, $5,000 to $100,000 plus dollars, who appreciates horology, wanting something they can wear while it appreciates. Target vintage pieces from established brands with original parts, papers, and box. Condition is everything. Downside? Need serious knowledge or get burned. Fakes everywhere. Franken watches common. Service history matters. Storage and insurance aren't cheap. Market moves fast. Not willing to learn or want quick liquidity? Watches aren't ideal. But love mechanical craftsmanship and patient? Watches offer wearable wealth that survived every economic crisis this past century. Number 1. Residential rental property. Perfect if you want income, appreciation, tax benefits, and leverage in one asset. Residential rental real estate has been the wealth-building engine for ordinary people for over a century. It survived the Great Depression, 1970s inflation, 2008, COVID, everything. Why rental property destroys inflation? Rents rise with inflation automatically. Prices go up, you charge more rent. Mortgage payment stays fixed. Tenant pays down your loan. Property appreciates, you get tax deductions, you're using leverage to control an asset that increases in value. One of few assets where banks give you 75 to 80% of purchase price at low interest. The numbers work. A $200,000 rental with $50,000 down, generating $1,500 per month, covers mortgage, produces cash flow, and appreciates 3 to 5% annually. Over 20 years, you've turned $50,000 into $300,000 plus equity, collected $100,000 plus cash flow, and gotten massive tax benefits. Ideal for someone with $25,000 to $50,000 to start, willing to learn landlording or hire management, wanting long-term wealth building with monthly income. Start with single rental, house hack, scale to multiple properties. Downside: real estate requires work, tenants break things, markets can stagnate locally, need reserves for repairs, not liquid, can't sell instantly, not willing to manage property, hate dealing with tenants, or need liquidity. Not for you, but want proven, leveraged, income-producing inflation protection. Residential rentals are king. There you have it. 11 weird, proven, inflation-proof assets that hold value when currency falls apart. Some you can start with a few $100, others require serious capital. But they all work because they're scarce, productive, or both. Match the asset to your situation. Young and aggressive, Bitcoin and Ethereum. Want stability, rental property and Lego. Specialized knowledge, firearms, watches, whiskey. Serious capital, land and water rights. Don't let wealth rot in a savings account earning 0.5% while inflation runs 5 to 8%. Pick 2 or 3, start building positions, and get the same protection the wealthy have used for generations. Subscribe now. I'm building an entire blueprint for thriving when systems fail, and you don't want to miss a single piece.